We had a question come in from Scott, a simple question related to earnings and trading options around earnings. Scott had asked, earnings events will increase volatility as you know, and as I am learning. But how much lead time does one need before earnings so that volatility will not increase or inflate the option price? In other words, how much prior to the earnings event does Scott need to get in before he's buying into too high of an implied volatility where he might experience the implied volatility crush? The specific situation is he felt RL, Polo Ralph Lauren, would decrease. He purchased a put at strike price of 90 one day before earnings. The earnings were coming out on May 24th before the market opened. The option price was 588. The stock price did drop at the morning of earnings, but the option was priced at 510. I realized this could happen with the IV crush. What I don't know is how many days before earnings is it best to buy. The second unknown is where can I find the normal IV for a stock? I remember you showing something on your options search, and I remember something with a graph. From past experience, we generally suggest looking 3 to 5 weeks prior to an earnings event if you're doing a straight IV play before an options announcement, meaning that you are buying a call, buying a put, or potentially buying a straddle or strangle, looking to close the position prior to the earnings event, hoping that the increase in IV leading up to that earnings event would be enough to profit on the straddle, the strangle, or the straight option position. Now, we have seen some people teach this method, and we tested it as well when we were developing sort of an earnings straddle or strangle play. They usually look for the same 4-week time frame prior to earnings. Through testing, we did not feel this was a consistent or very profitable way to trade the earnings. Sometimes it had merit, sometimes it did not. Now, clarification on this IV increase play, especially now. In a volatile market, this strategy is difficult with constant IV fluxes. They can work well in your favor. We buy a position, a straddle or strangle, 4 to 5 weeks before the earnings. The market pulls back as it has been doing. We see an increase in VIX and volatility across the market. We may be able to exit way before the earnings, depending on that increase. But with sudden runs up, after a little bit of a decline, if we get in at the wrong time frame, we could lose implied volatility, meaning our options are cheaper, and now we have to wait till closer to the earnings to get a profit. This can be dependent also on the positions going further out of the money. If I bought a call 3 to 4 weeks out in time, looking for the lower IV to get an increase going up to the earnings, but the entire market pulls back, well, now I'm deeper out of the money on that call. Sure, I could get an increase in IV going into the earnings or leading up to it or with the fall of the market, but now that I'm so far out of the money and the prices drop so much, I'm not getting profit or gains out of that position. In general, Ernie will look to use an earnings straddle maybe 5 to 7 days prior to the event for the nearest expiration date, but we plan on holding through the trade, normally through earnings, to get the better profit effect, knowing that we will cross that event and see a decrease in implied volatility. But for Scott, let's check it out. Regarding the position directly, you can go to the option chain once you've identified the option you're interested in trading. Click the More Information button, select Research, and then the Put Research. This will take you to the option research page. You'd see a similar page, of course, if you clicked Call Research in this case. The research page as a default gives us the total history of the option with the option bid price compared against implied volatility. This is for that particular option since it was released on the market. All of the other data that we have for this option is also available on this page where you can view probability, Greeks, percent IV range, last trade time, price ratios, and more. Delving deeper into RL, that June 90 strike put that Scott looked at, we do see a relative increase in the last 7 days leading up to the earnings on May 23rd. Near low on 5/17, 6 to 7 days before earnings, was at 0.58. And then there was a steep increase in implied volatility up to 0.75. But if we notice here, the lowest IV was about a month prior, when the option was initially released of around 0.49. So we have that 3 to 4 week time frame with the lowest IV, and we do see an increase in IV in that sort of 6, 7 to 10 day time frame leading up to the earnings event. On May 24th and after, June 90 put has returned to its near average IV. On the 24th, it was around 0.54. This means that when Scott bought the put prior to the earnings, it was near the highest IV of around 0.76. And after the event, the stock didn't move that much. It did have that morning decline as we saw, but it wasn't drastic. So the implied volatility went back to sort of the norm and back to sort of the lower range here, down to 0.54, 0.52. Remember, the lowest we saw was at 0.49 when the option was released. And we can see a similar chart for ANF, Abercrombie and Fitch. This is the one that took that big hit on May 24th. It was down 30% or so with the complications that retailers were having during their earnings. This chart on the option research tool is for the 27th of May, 27 strike put. That was the at-the-money put at the May 23rd close. Again, we see the high IV rise in the last 7 to 10 days leading up to the 23rd at around 513. But the lowest IV was 4 to 5 weeks ago when it was down at 0.8 or 0.9. We're looking at a volatility of close to 1.1 in the 7 to 10 days leading up to the earnings, and at almost 2.2 the day right before the earnings event. So much higher values than what we saw with RL. But again, that big lead up does happen that last 7 to 10 days prior to earnings, but the lowest value was 4 to 5 weeks ago. Right after the earnings, the stock plummeted 30%. IV still held relatively because of the decline, and this put would have been extraordinarily profitable, even though 2 days later, the implied volatility is down to 1.4. This was on May 27th at around 12 noon. It lost 50% almost of its implied volatility. But because of the movement in that case, it would have been a very profitable position with a 30% decline. Now, we had talked earlier about the effects of the general market, which could be leading to an increase in IV as well as going into the earnings. And this was the case for ANF and for RL in the retail sector going into their earnings. Both saw an increase in last 7 to 10 days heading into the earnings, but it was probably higher in both situations than you would normally see. This is the retail ETF, and as you can see, the dips in the retail ETF started around 518, which meant volatility on the retail stocks was increasing because Target took a big hit similar to ANF with their earnings, as did others as we shifted through the cycle leading up to the earnings of RL on the 23rd and ANF also. But not every stock will have the same pattern. Hewlett-Packard reported on May 31st, and here on the options research tool, we see something similar. There was a recent low 10 to 15 days out prior to the earnings on 516. We're looking at a value of about 0.49. Leading up to the earnings, the implied volatility of this option moved up, as did others for HPQ, up to almost 0.85. But then it came back down again to 0.6 and started to move back up starting on the 25th. Again, as we can see, the lowest IV was about 4 to 5 weeks ago when it was down around 0.4, 0.39, somewhere in that range. But in the case of Hewlett-Packard, other things were at work. At the top is that same chart we were just looking at on the options research tool for the June 39 put on Hewlett-Packard, expiring on June 3rd. That big increase we saw from about 517 up to about 520 is the same time we saw the stock drop from 39.50 down to about 34.50. A 5-point move on barely a $40 stock at the time. That's well above 10%. That decline is what mainly was causing the increase in implied volatility, not the run up to earnings. Because as you see, on the 21st and the 23rd, Going ahead into the earnings coming up on the 31st, the volatility started to fall as HPQ settled and started to move back up in price. So the market conditions will also have an effect on your planned increase in IV and may even show you a decrease in IV if the market conditions are strong on that stock as it heads into earnings. Now, determining the effect of an IV crush, which will happen, and yes, you'll likely see an increase in IV leading up to those 5 to 7 days, maybe 7 to 10 days before an earnings event, regardless of what the market conditions are doing. But it can be a lower increase than expected or a higher increase than expected heading into earnings, depending on those market conditions. But you should expect an IV crush after the earnings. And on PowerOptions, there's 2 tools you can evaluate to determine this. First, I want to determine the range to gauge the worst case scenario. If I'm researching a straddle, a strangle for an earnings play, or just buying a call or buying a put or another strategy, I will go to that options research page. I will take a look at the implied volatility versus option bid of the options I'm considering to use in this earnings play. I'll also look at the hard numbers, the current implied volatility. This is for that HPQ June 39 put. It was at 0.67. I can see the IV over HV, IV over SIV, the percent implied volatility range. Where is the option's implied volatility right now compared to where it has been over the life of the option? And it's at 81%. We're very near the high range, as we can see by the chart. But the total IV range since this option was released on the market is 0.28 to 0.8309. So we're in the 81st percentile right now at 0.67. From the option chain or from other tools, I can link to the Black-Scholes calculator. This shows us the expected value of the option over time if the stock stays even at the same stock price, but using the current implied volatility of that near-term option. So what we're seeing here is we head into the earnings on May 30th, May 31st. We'd still expect this option to be priced at 118 on May 31st, even if the stock was trading at 38.55. And on June 1st, after the earnings and some of the movement clears out, we'd still expect the option to be worth 101 with an implied volatility of 0.67. But I want to determine what is my expected flux in IV and what is my expected decrease in expected value of my options when I make that change. On the calculator tool, we'll just go ahead and change that volatility number for the option we're researching to either the lowest value in the worst case scenario of 0.28, which we saw on the research page, or somewhere in the mid-range. Let's take a value of 0.45. I'm going to leave the stock price the same, expected at 38.55. And this gives us a gauge of what to expect. On May 31st, instead of a value of 118, we have a value of 88 cents due to the decrease in implied volatility. And on June 1st, after maybe everything settled down, instead of having a value of 101, we'd expect a value of 77 cents on the position. That's a 25 to 24% difference in expected price, respectively, on the 2 days following the earnings event. Another tool that we can use is simply using the profit and loss chart and the calculate feature on the profit and loss chart or custom spread tool. I could go to the custom spread tool and just put in the option I was going to buy, my June 3rd 39 put at 169, or I could link to a profit and loss chart if I found this on a search or potentially from the option chain as well. And down below, we're going to do the same thing we just did on the Black-Scholes pricing model, but we're just going to change the implied volatility in that calculate field, leaving the stock roughly at the same price. Now, originally, as we saw, on June 1st, the expected value of this option, if it retains its implied volatility of around 0.67 or 0.68, would be $1. It'd still be a loss of 69 cents, but the expected value would be $1, even if the stock stayed at the same price. We change it to mid-range, and we see essentially the same thing we just saw in the Black-Scholes pricing model. Keeping the stock price the same, June 1st, a day or so after the earnings come out, changing the implied volatility to 0.45 gives us an expected value of 75 cents, $75 for one contract. Whereas we saw in the Black Scholes, it was about the same, about 77 cents. So that's the decrease we would expect. Again, 24 to 25% by just going to the mid-range. If we put this down to 0.28, this option might show us only a value of 25 cents, maybe 27 cents, a much bigger decrease because of the IV flux. But you can use the Black Scholes calculator or the calculate feature on the profit and loss chart to gauge the expectations of what you might gain or lose due to an implied volatility drop after the earnings. So in summary for Scott, in our examples, we saw that the lowest IV was about 4 to 5 weeks prior to the earnings. But that is also dependent on current market conditions and the flux that may happen between that time frame leading up to earnings. We did see the bigger IV moves in a shorter span happen about 7 to 15 days before earnings. But as we saw with RL and ANF, this could be due to the current market, sympathy declines for other stocks in its sector, missing earnings completely and causing an increase in volatility, but we would still expect to see some IV increase 5 to 7 to 10 days leading up to the earnings, not 1 or 2 days to try to do an IV play. Make sure you know what to expect. Check the total IV range from that option research page, and then calculate the expected change using either the Black Scholes calculator or the calculate feature on the profit and loss chart to know your expectations of what could happen to your position in the worst case scenario of IV going all the way back down to the bottom range or even the mid range, as it's probably near its high right now or moving up to it. Now, of course, as I always like to say, we took a look at 3 quick examples here: Scott's RL position, the ANF position, and we looked at what happened with HPQ. But 3 examples do not the market make. Implied volatility flux prior to an earnings event can happen sooner, or it could happen later. It could happen within the last 2 to 3 days, depending on market conditions and the stock itself. It could happen 15 days, as we saw in one example, with the biggest increase, but that was also dependent on market conditions. IV flux prior to an earnings event may not even be that large of a move, depending on what's going on with the stock, that sector, or the market as a whole. You will see an increase, but it might not be as big as we saw in some of these examples. Earnings plays, of course, are risky. You could lose up to 90% or more what you invest into a position if I buy a straddle, a strangle, buy a call or buy a put, or even do a type of diagonal spread. If the event causes a movement outside of my original expectations, I could be seeing large losses, especially even if I'm doing short straddles or short strangles, and I see a 30% drop and I thought I was safe 10% out of the money. I'm in a world of hurt right now on the naked call side or likely the naked put side. Options, of course, involve risk and may not be suitable for all investors. Make sure that you run your expectations and potential profit and loss charts, including IV flux on these earnings plays, to know if you may even have a sustainable and potentially profitable position in the worst case scenario of an IV crush or an IV collapse.